The silver market has always been a magnet for passionate investors, but there's a growing divide between what everyday stackers believe about this metal and what the dealers selling it to them actually understand about the underlying market dynamics. And that gap matters more than most people realize, because the narratives shaping buying decisions aren't always aligned with the economic forces actually moving price. If you've spent any time in precious metals communities, you've encountered the archetypal silver stacker, the investor convinced that silver represents the ultimate asymmetric opportunity, a coiled spring waiting for its inevitable explosive move higher. The conviction is real, the commitment is genuine. But when you sit down with the dealers who facilitate millions of dollars in transactions every month, who see order flow from retail buyers, institutional players, and everyone in between, a more nuanced picture emerges. One that doesn't necessarily contradict the bullish thesis, but adds layers of complexity that rarely make it into the promotional content flooding YouTube and social media. Let's start with what dealers consistently observe that contradicts the dominant stacker narrative. The first truth they'll tell you is that retail demand, while passionate and vocal, represents a surprisingly small fraction of actual market-moving volume. The silver market is enormous. Annual supply exceeds 1 billion ounces when you account for mining output and recycling. Industrial consumption alone dwarfs the entire physical investment demand from individuals stacking bars and coins. This creates a fundamental tension. Stackers often perceive themselves as part of a groundswell movement that will overwhelm available supply and force prices skyward. Dealers see something different. They see episodic waves of retail enthusiasm that create temporary premiums and supply constraints in specific product forms, but don't fundamentally alter the broader supply-demand equilibrium that institutions and industrial users navigate. Here's where it gets interesting. Dealers will tell you that premium compression, the difference between spot price and what you actually pay for physical silver, behaves in ways that reveal important truths about market psychology. During periods of intense retail demand, premiums can spike dramatically. We saw this in 2020 and 2021 when certain silver products carried premiums of $8, $10, even $12 over spot. Stackers interpreted this as validation, proof that physical metal was scarce and that spot prices were artificially suppressed. But dealers understood it differently. They recognized it as a logistics and production bottleneck in retail-oriented products, not a systemic shortage of silver itself. Industrial users weren't struggling to source material. Futures markets weren't indicating physical delivery stress. What was constrained was the minting capacity to turn bulk silver into the specific coins and small bars that retail investors prefer. This distinction is critical because it shapes how you interpret price signals. When premiums are high, stackers often accelerate purchases, believing scarcity is confirming their thesis. Dealers, meanwhile, see a temporary arbitrage opportunity that will inevitably normalize as production catches up or demand cools. And historically, that normalization has always occurred. Premiums eventually compress back toward more typical levels, which means anyone who bought aggressively at peak premiums has locked in a structural disadvantage that has nothing to do with whether silver ultimately rises in value. The second major disconnect involves the industrial demand narrative. Silver's dual nature as both monetary metal and industrial commodity creates a conceptual framework that stackers find enormously compelling. The idea that technological advancement, particularly in solar panels and electronics, will create unstoppable demand growth while monetary debasement drives investment demand feels like a perfect convergence. Dealers don't dispute the industrial use cases. They see the data. But they also understand something that doesn't fit neatly into the bullish story. Industrial users are price sensitive. They engineer around expensive inputs. When silver prices rise significantly, manufacturers optimize designs to use less material, substitute alternative conductors where possible, or accept slightly degraded performance to manage costs. This dynamic doesn't mean industrial demand disappears, but it does mean it's more elastic than the stacking community typically acknowledges. Solar panel manufacturers aren't indifferent to whether silver costs $25 an ounce or $50. At higher sustained price levels, innovation accelerates toward reducing silver content per panel or exploring alternatives. Dealers witness this in real time through shifts in industrial order patterns. They see large industrial buyers pull back during price spikes and become more aggressive during dips, the opposite behavior of retail stackers, who often buy most aggressively when prices are rising and enthusiasm is peaking. Then there's the conversation about price suppression, a topic that generates intense emotion in stacking communities. The belief that major banks and institutions actively manipulate silver prices downward through futures market activity is almost doctrinal among many stackers. Dealers have a more measured perspective. They acknowledge that futures markets absolutely influence spot prices, and that large institutions have vastly more capital and information advantages than retail participants. But they also point out that manipulation, in the sense of indefinite price suppression against fundamental forces, is extraordinarily difficult to maintain in a market with real physical demand and supply constraints. What looks like suppression often reflects the reality that silver, unlike gold, faces significant industrial recycling, substantial above-ground inventories, and production that can respond to price incentives. When dealers look at silver's price history, they see a commodity that has experienced genuine bull markets when macroeconomic conditions aligned. The late 70s surge, the 2011 peak. These weren't defeated by manipulation. They ran their course as speculative fever exhausted itself and supply responded. The uncomfortable truth for those convinced of perpetual suppression is that silver has had opportunities to break out when broader inflation fears, currency concerns, or investment flows were supportive. Sometimes it capitalized on those moments. Other times it didn't, not because of shadowy manipulation, but because the fundamental supply-demand balance, inclusive of recycling and production responses, reasserted itself. Here's what dealers emphasize that stackers often resist. Silver is more volatile than gold, but that volatility cuts both ways. The same industrial demand and smaller market size that creates upside explosiveness also creates downside vulnerability. When economic growth slows and industrial demand softens while investment enthusiasm simultaneously cools, silver can decline more severely than gold. The 2011 to 2015 period demonstrated this painfully. Silver fell from near $50 to under $14. Stackers who bought at elevated levels and held on experienced nearly a decade of underperformance, even as gold eventually recovered and made new highs. Dealers also notice behavioral patterns that rarely get discussed openly. The average retail silver buyer exhibits classic momentum-chasing behavior. Purchases surge when prices are rising and media attention intensifies. Buying slows dramatically during extended periods of range-bound or declining prices, precisely when valuations are more attractive. This isn't unique to silver, it's universal human psychology, but it contradicts the disciplined accumulation strategy that successful long-term investors employ. Dealers will quietly tell you that the most successful precious metals investors they've worked with buy consistently and unemotionally, often increasing purchases when sentiment is poor and prices are subdued. The passionate stackers loading up during viral social media campaigns and price spikes tend to have more disappointing outcomes. There's also a conversation about exit strategy that dealers wish more stackers would consider seriously. The conviction to buy is often absolute. The plan to eventually sell, if it exists at all, is usually vague. Silver is framed as insurance, a hedge against systemic collapse, a wealth preservation tool for the next generation. All potentially valid perspectives, but dealers handle the other side of that equation. They buy back silver from estates, from investors who need liquidity, from people whose circumstances changed. And what they observe is that selling physical silver, especially in larger quantities, often involves accepting buyback prices that reflect wholesale rather than retail levels, particularly when premiums have normalized or compressed. The spread between what you pay and what you can sell for is wider in silver than in many other asset classes. That round-trip cost is a real drag on returns that doesn't feature prominently in accumulation narratives. None of this is an argument against owning silver. It's simply the reality that dealers navigate daily, the gap between narrative and mechanics. Silver absolutely has qualities that make it worth considering as part of a diversified portfolio. Its industrial applications do create baseline demand that purely monetary metals lack. Its historical role as money and store of value spans millennia. The supply is finite, and extraction requires real energy and resources. These aren't trivial attributes. But they don't automatically translate into inevitable price appreciation on timelines that investors expect. What dealers recognize, and what often gets lost in the enthusiasm, is that successful silver investing requires understanding the macroeconomic context that actually drives meaningful price movements. Silver performs best when you have a specific combination of factors. Negative real interest rates that reduce the opportunity cost of holding non-yielding assets. Inflation concerns or currency devaluation fears that drive safe haven demand. Strong industrial growth that keeps baseline demand elevated. Risk appetite that pulls speculative capital into commodities. When these align, silver can deliver exceptional returns. When they don't, it can languish for years, regardless of how compelling the supply deficit narratives sound. The dealers who've been in this business for decades have seen multiple cycles. They've watched silver capture imaginations during periods of monetary uncertainty. They've seen it fade from attention during long stretches of stability and growth. What they'll tell you, if you ask without the assumptions, is that silver rewards patience and humility more than it rewards conviction and urgency. The metal will still be here in 5 years, in 10 years. The opportunity to own it won't disappear, but the price you pay, the premiums you accept, the timing of your accumulation, these details matter enormously to whether your investment ultimately serves you well. So where does this leave the individual trying to navigate between stacker enthusiasm and dealer pragmatism? Perhaps with a more balanced framework. Silver can be part of a sound long-term strategy, but probably in moderation rather than concentration. Buying during periods of weak sentiment and compressed premiums likely serves you better than chasing during viral surges. Understanding that your investment exists within a massive, complex global market where you're a small participant might encourage more realistic expectations. And recognizing that dealers, for all their self-interest in facilitating transactions, actually possess valuable perspective earned through direct market exposure might be worth considering. The truth from silver dealers isn't that silver is bad. It's that the narratives often oversimplify the reality. The market is bigger, more complex, and more influenced by institutional dynamics than the stacker communities typically acknowledge. That doesn't invalidate the reasons to own silver. It just suggests that the path to success involves less certainty, more nuance, and greater attention to macroeconomic context than the prevailing narratives tend to encourage. And in a market as volatile and psychologically charged as silver, that perspective might be the most valuable insight of all.